The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho. These are your headlines. UBS reports $1.4 billion in third quarter net profit as the Swiss lender accelerates its integration of Credit Suisse. We'll be hearing from the UBS CEO Sergio Motti at the top of the next hour. Standard Chartered's quarterly pre-tax profit more than doubles, boosting shares in Hong Kong as the lender lifts its income outlook and ups its payout pledge. We'll be speaking to the Group CFO Diego De Giorgi in just a few moments' time. Alphabet's cloud division delivers blowout results, pushing annual revenues 15% higher in the third quarter, even as growth in its search and YouTube businesses slow. Meanwhile, gilt yields trade at a post-election high as investors count down to Labour's first budget in 15 years, with investment topping the Chancellor's agenda. Trade Minister Douglas Alexander tells CNBC what to expect.
After years of uncertainty and turbulence, both in British politics and British economics, Britain is back and we're open for business.
UBS crushed earnings expectations, posting a third quarter net profit of $1.4 billion against $740 million forecast by analysts in a company-provided poll. It reported a return on its CET1 capital of 7.6%. And on the client side, the Swiss lender posted $25 billion in net new assets and said it is on track to hit its full-year target of $100 billion. So the big takeaway messages here, the company just telling up some more gross savings into year-end. Those gross savings are seen at about $7 billion. So just how much more they've extracted out of the business is quite key at this stage. In terms of what we're seeing on integration expenses, $1.2 billion, and of course still in the wash-up from the Credit Suisse takeover here. It expects a continuation of third quarter market conditions entering the fourth quarter. And of course, it was a fairly turbulent number of weeks and months that we had in the third quarter. We saw market events in the month of August and of course in September. So continuation of market conditions, where don't forget we have climbed to fresh records again on stock market. So these conditions and the signaling here are all important in terms of what we're seeing elsewhere too. The company plans to complete a buyback, $1 billion worth of share buybacks in the fourth quarter. But I think what is key here is the company also talking about transactional activity that was strong at its global wealth management business and investment bank. That is key, just how strong the business is tracking. And we're going to be hearing from the UBS CEO Sergio Motti at the top of the next hour. Well, let's switch banks. Standard Chartered has topped expectations with a more than 170% jump in third quarter pre-tax profit, coming in at $1.7 billion. The lender upped its full-year income outlook, now forecasting operating income will rise towards 10%. I'm pleased to say Diego De Giorgi joins me now, Group Chief Financial Officer at Standard Chartered. Thank you very much for joining us.
Thank you for having me.
And let's get into the numbers today. You've seen a quarterly profit more than double from a year ago. This was a beat of analyst estimates. Just walk us through some of the strength that you saw in the latest numbers.
Sure. So an excellent quarter, the third in a row, and very much the business firing on all cylinders. We have had 12% growth in the top line and over 30% growth in the bottom line. If you think about engines of growth, that gem of a business that is our wealth management business has grown at over 30% year on year after 2 quarters of growing at over 25%. So it's clearly a great result. What that gives us, together with the sharpening of our focus towards our areas of higher returns, is it gives us confidence to raise guidance, as you just mentioned, Karen. Raised guidance for revenues this year towards 10%. More importantly, for return on tangible equity for 2026 towards 13% from 12%. And we've upped our guidance for distributions over the next 3 years, 24 to 26, from over $5 billion to over $8 billion.
How much visibility do you have at this stage, given we are staring down the barrel of a US election? I've got to say, I was in Washington, D.C. last week, and it was the big elephant in the room as we were talking about outlook statements. It's like, well, we don't know on the back of the US election who is going to be president. We don't know what sort of tariff regime. We're talking about if it's one candidate or the other. And of course, we're still waiting for China to pick up some speed. So how much visibility do you have?
So lots of moving pieces, indeed, both in Washington and also in China, with the pronouncement of the Standing Committee of the NPC next week in terms of potential fiscal stimulus to be added to the other measures. Look, we've navigated the geopolitical seas for 175 years of our history. If there's one thing, particularly in Washington, where there is bipartisan consensus, is clearly on the China angle. I think that what the world is telling us is that globalization is far from dead, but it moves on very different corridors. And those corridors are increasingly, I don't particularly like the term South-South, but they are increasingly the South-South corridors of the world. And Standard Chartered sits astride those corridors of trade and those flows of commerce and of capital with countries like Singapore, ASEAN, India, the Middle East, and Africa.
I was having a very similar conversation the other week with other banks in the region, and I think the reality is we're seeing supply chains diversify away from China, which means your business is moving around. How much more of that is still playing out even in 2024?
Very much an open field. By the way, you mean you talk about supply chains diversifying away from China. It's also the supply chain of China that is diversifying away and into places like Vietnam, Malaysia, all places where we are very strong. Again, it's the fragmentation of trade. Fragmentation of trade for the banks, I assume that the other bankers that you were talking to would concur. While it creates some uncertainty, it also creates great opportunities, because when trade or flows of commerce or of capital are more complex, that's where the services that we render, which are global services but delivered on a local scale, are particularly valuable.
I want to ask you about China, because you have taken a hit in the past when it comes to the real estate sector. We know that there are now measures to try and shore up property in China. How much of this gives you some confidence versus what we've seen in previous quarters?
So the measures that have been enacted and are continuing to be enacted, I referred before to what's supposed to happen next week, are clearly important, and this time they are very coordinated. You're really seeing the PBOC, you're seeing the government, you're seeing SASAC all coming to the help of the market. From our point of view, in terms of impact, it's very much in the rear view mirror. We have taken our medicine when we had to. Our numbers reflect that.
Nearly 1 billion in write-downs.
In the past, and right now that is something that does not affect us going forward. I think that this time, and the proof will be in the pudding really next week, this time these measures feel different. And we are seeing the green shoots both in our wealth management business, which again, you've seen the results, and also in our corporate bank.
But if we're not in the trough when it comes to China property, which was one of the messages I also had last week, if we're not quite there yet, does that mean further write-downs could still be required on the China exposures?
They might, but again, given that at this point we are 90% covered and provisioned for that, whatever happens will have a de minimis impact for Standard Chartered.
Talk to us about the outlook in terms of international markets, because we're just hearing from UBS as well that fourth quarter perhaps looks a little bit like the third quarter, some of the similar trends playing out. Would you agree, or are you concerned about anything out there on the horizon at this stage on markets?
So it's the business of a CFO to be concerned. Obviously, one has to do that. But I think that in terms of trends, in terms of banking, we are clearly seeing, and you see our numbers, 7% up in our banking business. What started as a great refilling of the pipelines in the West is now extending to other markets. In terms of the capital markets business, the volatility that events like the one you mentioned is upcoming, and others ought to come to the help of the trading businesses. And in general, the environment feels volatile but conducive to business.
Just give us a sense as to where the strategy is heading from here, because we know a lot of banks are also managing their exposure in markets where they don't feel like they have a big enough footprint, downsizing those markets to concentrate on others. Talk to us about the portfolio shuffling that you're doing in the business when it comes to big Western markets, but also in Asia.
Absolutely. So what we have announced today is we have announced a sharpening of the focus on those businesses that are our absolute great performers, that have been performing already well historically, and where we want to double down on the investment. Those are certain areas of our corporate and investment bank, particularly having to do with large corporate and financial institutions, and in wealth management, our business that caters to affluent customers. What we are going to do there is continuation of our ongoing strategy of sharpening that focus and reshaping our perimeter. And the form that these measures will take is going to be very different. In some cases, we might be selling some portfolios. You might have seen 2 weeks ago, we sold a large portfolio of personal loans in a country that is very, very important to us, like India, and that has great potential for growth, but where that particular product was not fitting with our ongoing strategy. In some cases, we might discontinue some products, and in some cases we might selectively exit some markets.
Just quickly, budget day here today in the UK. Are you watching anything closely from the Chancellor?
Look, of course we are going to be watching, but the heart of Standard Chartered beats in Asia, the Middle East and Africa, so it won't have much of an impact for us. But
indeed. Just to that point, net interest margins is a big thing for banks. And we know we've just gone through a very pointy end of the cycle where it was very easy for a lot of the banks to make profit because of very strong returns thanks to those net interest margins. But it is turning now. Does that mean that it sets you up nicely because you're a global bank and you have very different interest rates in some jurisdictions versus others? Or does it just get challenging all around? How do we think about the NIM story?
So two things. One, from the point of view of the net interest income itself, the diversification. I mean, we exist across many currencies, many interest rates, many different countries, undoubtedly plays a diversification effect within the context of a decline in interest rates, for which we have long been prepared and for which we have put in place measures, and we continue to do so. Perhaps more importantly, what that means is that your engines of non-net interest income need to be very strong, and that's when our wealth management growing at 30% year on year, our markets business growing at 16% year on year this quarter, and our banking business at 7% clearly show you that we have invested in those business engines that will counterbalance whatever weakness there is in net interest income.
Diego, thank you very much for joining us in person to talk us through numbers today. I appreciate the time. Diego Di Giorgi with us, Group Chief Financial Officer, Standard Chartered. Let's move on to tech, as Alphabet shares rose in extended trade after the tech giant beat on the top and bottom lines. Third quarter revenue rose 15% on the year to more than $88 billion, boosted by its cloud unit, which saw a 35% bounce in growth. Our colleague Deirdre Bosa filed this report.
Alphabet shares rising in the after hours after its third quarter report that really eased investors' worst fears that its core search advertising business, still its bread and butter, could be hit by new competition in a generative AI world. No evidence of that so far. Ad revenue came in a little better than expected, as did YouTube and cloud revenue. That said, competition is only set to intensify in the months ahead. However, Sundar Pichai on the earnings call struck a very optimistic note. He said that AI overviews are reaching more than 1 billion users on a monthly basis, and that is increasing overall search usage. And that's a positive sign that Google is introducing AI search to a wider group of users while successfully monetizing it through advertising. Now, the other key piece that investors were waiting on was spending. First quarter for new CFO Anat Ashkenazi, she said that she expects quarterly CapEx in the fourth quarter to be at a similar level to the third quarter. As for 2025, she said that there will be an increase, but not the same step up that they saw from 2023 to 2024, perhaps suggesting that the growth of CapEx at Alphabet has peaked, and at the same time, indications that they're seeing better efficiencies around AI in their own business. CEO Sundar Pichai said that now a quarter of Google code is being generated by artificial intelligence. Deirdre Bosa, CNBC Business News, New York.
Well, speaking of tech, we did see some fresh records on the markets again yesterday. Sylvia.
Exactly. Good morning, Karen. It's been another exciting day when you think about US equities. Just to give you an idea, the Nasdaq hit a fresh record high during Tuesday's session. And indeed, though, when you think about the broader sentiment, there's quite a lot happening within the tech sector. We're hearing from the 5 out of the Magnificent 7 this week. But when you think about the broader narrative within US stocks, the Dow saw its 6th negative session in 7. So this rally that we saw in terms of tech stocks is not across the board. We are seeing pressure. We saw pressures when it came to the Dow as well as the S&P, which was basically just flat on the day. Let me take you to the bond market too. It has been another interesting time when you think about treasuries. This part of the market has been very much focused on the upcoming election in terms of potential changes to monetary policy as well. We know that this week we're not going to hear from any of the Fed officials. They are in their blackout period. But of course, a lot of investors trying to figure out whether the Fed is going to cut rates by 25 basis points next week. Here, though, one of the question marks is that we are seeing a bit of a difference in terms of monetary policy when it comes to the Fed and at the same time what the ECB will be doing. Let me also take you to the currency space. It has been such a strong time for the US dollar, really. Let me just share a couple of figures with you because the dollar index was actually down during yesterday's session. But look at this number. Month to date, it is up 3.5%. So some of that narrative I was just highlighting there in terms of the Fed and that in terms of the upcoming US election have put pressure in other currencies, but not when it comes to the dollar. In terms of some of the commodity moves, this is the picture. It has been a very volatile week, really, when you think about oil prices. They started the week down almost 6% in one day. That has somewhat dissipated thus far, but indeed it continues to be an important part of the market to monitor, as those geopolitical tensions in the Middle East continue to be one of the things in the minds for investors. In terms of moves in Asia, this is the picture. We are seeing a bit of a downward pressure when it comes to the Hang Seng as well as the Australian market. But that positive momentum in Japanese equities continues. The Nikkei 225 at this stage up almost 1%, Karen.
Sylvia, thank you very much. Terrific remarks there, I think, on the dollar, and we're going to talk more about that ahead of the election. Dollar certainly has been king during the month of October. Now, ahead on the show, with the US election less than a week away, how are investors trading Trump? We'll discuss how the market is gearing up for the vote next. Plus, alphabet beats on the top and bottom line. We'll delve deeper into the numbers in about 15 minutes' time. And Rachel Reeves prepares to deliver her first budget as UK Chancellor. Hoping not to spook the market, we'll discuss what to expect with Dominic Johnson, the UK's former investment minister. That interview is coming up at 8:30 GMT. With less than a week to go until Election Day, presidential candidates are making their final pitches to voters. Democratic nominee Kamala Harris delivered a closing argument speech in Washington, D.C. at the location of former President Donald Trump's rally before the 6th of January Capitol riot. Trump held a rally in the swing state of Pennsylvania, trying to win over Latino voters after comments about Puerto Rico by a comedian at his Madison Square Garden rally sparked an outcry. The European Commission has given the final approval for tariffs of up to 45.3% on imports of Chinese-made electric vehicles, sending shares of automakers lower. China's Commerce Ministry said it does not accept the tariffs, calling them protectionist. As former President Donald Trump gains momentum in opinion polls, European leaders are preparing for more American protectionism, which they expect no matter who wins the upcoming election. Well, Sylvia joins us with more. Sylvia, I was in the heartland last week. I guess so DC very much in election mode. But as to who wins the election, still open choice at this point, I think, for voters. But if it is going to be Trump, and that is the big if, do we see more tariffs and how are we positioning for it?
That is the expectation. But what I've been trying to do is figure out how European officials have been feeling over this period, because we actually reported last year that the EU was preparing for a potential Trump win. So already at that point, they were already thinking, what can we do to protect our economies? Then we saw a change in the race when Joe Biden dropped out and was replaced by Kamala Harris. European officials were actually very happy about that. They thought that having Kamala Harris now in the race could actually increase the chances of seeing a Democrat president. Now, though, as you look at the polls, I was posing the question to several European officials, what does this mean for you? Are you intensifying your plans in case of a Trump win? And the answer I obtained was very much that it doesn't matter whether they're going to see Kamala Harris winning or whether that's going to be Donald Trump, because it will be America first. How intense that's going to be remains to be seen, but nonetheless, the Europeans seem to be very much focused on trying to protect their economies, trying to increase their strategic autonomy, and indeed cut some of the ties, some of the dependencies that they have with China, as well as with the United States, really.
Yeah, it's a good setup, Sylvia, and I think we're talking about two huge economies that Europe will be trading with. I mean, I had these conversations in Washington last week. I've got a little bit of tape to play for you, because I think I asked just about every policymaker what they thought the outcome could possibly be and what the impact of any trade tariffs would mean for Europe. Let's take a listen.
The elephant in the room is the policy perspective in case of a Trump administration. In that case, we need diplomatic efforts to convince whoever enters the White House that it's not in the best interest of the US to have a trade conflict with the European Union. We would have to consider retaliation.
Tariffs usually are borne by businesses and consumers in the country that introduces them. They also have the repercussion of measures taken to respond to these tariffs, and this retaliation is happening in 75% of the cases.
Europe, America, we will still need allies. We will still need partners that we can cooperate with. We have so many challenges that we do ultimately need to face together if we're going to get on the better side of them. And if the US does consider in the future or the changes they want to make, I hope they're also aware of what we're aware of, which is that cooperation and partnership has a really high premium in the world that we're in at the moment.
So a couple of points are coming through in the conversations that I had, which are, if Trump is elected, does he follow through with the tariffs, or is it just a means to an end to try and negotiate some sort of better outcome with trading partners? That was one point. Mm-hmm. If we do get follow through, to Kristalina Georgieva's comments there from the IMF, that most cases are met with retaliation, and the lines through from the German finance minister were effectively that they would retaliate. They would not take it lying down. And you speak to all of these European policymakers too, and the view is that, look, they were all caught flat-footed last time round. It was not going to happen this time round.
Not this time around. Actually, two officials told me they wouldn't be surprised if Trump were to win, and that they are prepared for any eventuality in this case.
With a list, right? They've been raking over numbers in various parts.
There was one person, one European official, that told me that there's bold initiatives being prepared as we speak in case of a Trump initiative, in the case of a Trump presidency. I'm not sure what's the detail there. We have to wait and see, but we know that in the past, every time that there were new tariffs from a Trump presidency, the Europeans would retaliate. So that wouldn't be different in this time around. And just perhaps to share some figures with our viewers, the EU and the US have the biggest trade relationship in this world. It hit a peak in 2021 of 1.2 trillion euros. That's $1.3 trillion. And it is huge. It's very important for an open European economy. So any changes from a US perspective there would have a lot of ramifications for European economies.
If it is just a bargaining tool with US companies to invest and stay at home, does it mean you get something very similar to the Inflation Reduction Act, but without that type of checkboard or stimulus? Do you just get the same sort of decisions where companies decide to stay at home? Number one. Number two, there is a view that, look, everybody is effectively a loser here. Europe definitely, and one policymaker said to me, I think it was off camera actually, saying, look, the reality is that it would be punishing, it would be absolutely disruptive, and it means that European economies would not grow as much. It means everybody in Europe is poorer, and it allows the populace to have more say, which is very negative, of course, for Europe, but for the United States as well, because it means inflation could come back, and just as we have policymakers starting to think inflation is in the rearview mirror, it, of course, interrupts the economic cycle.
And I'll actually just broaden out to say that there's also political implications here. You were highlighting there, populism and the impacts there, but we're already witnessing this. If you think about some of the remarks from the Prime Minister of Hungary, Viktor Orban, he has a totally different tone from other European officials, saying if Trump wins, he's actually going to open bottles of champagne. That is totally different from von der Leyen, Emmanuel Macron, all of them are saying at this stage. And that also poses the question, can the EU27 work together to potentially retaliate against new tariffs from Donald Trump. It's also a challenging moment for European unity from that point of view. And of course, the election is going to have implications on that.
Yeah, and where does it leave the war in Ukraine? Where does it leave challenges around the Middle East? And where does it leave climate change? Sylvia, thank you very much for that. And for Sylvia's full piece on the EU's preparations, you can head online to cnbc.com. It's a big day here in the UK as Chancellor of the Exchequer, Rachel Reeves, will pledge to invest in her budget speech today. The governing Labour Party's first in almost 15 years and the first ever by a female Chancellor. Reeves has confirmed she will relax borrowing rules in order to fund the package. But Treasury sources have told our sister channel Sky News there is a £40 billion black hole in the country's finances, suggesting tax rises and spending cuts will be required in some areas to avoid spooking the markets. Deutsche Bank says it expects today's budget to contain the biggest single increase in spending since the Office for Budget Responsibility was formed back in 2010 at £35 billion. Now, Reeves' speech isn't expected to carry many surprises. The government has already briefed many of the announcements in advance. It's angered parliamentary officials but could help avoid a sell-off in gilts during the speech itself. Now, that said, the yield on the 10-year British paper broke past the 4.3% mark on Tuesday, up from 3.75% in mid-September. And you can see morning session 4.31%. Our colleague Dan spoke exclusively to the UK Minister of State for Trade Policy, Douglas Alexander, on the sidelines of the FII in Riyadh and asked him what investors need to know ahead of the announcement.
What they need to know is after years of uncertainty and turbulence, both in British politics and British economics, Britain is back and we're open for business. This will be a budget that, if you like, repairs the fiscally impaired balance sheet we inherited, delivers economic stability, delivers economic investment and delivers policy reform. That's going to be the main story of tomorrow's budget, I sense, when we hear Rachel Reeves speak in the House of Commons.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.